This is Andy Profit. I'm the SIG chair for the AAI Portland Income Group, and I want to welcome everybody, and especially our members from the Silicon Valley chapter. Nice to see everybody. Yeah, this picture is the way Portland looks when it's sunny. Today it's not so sunny. And off there in the background, you can see Mount Hood. Last week was very nice. This week, a little bit cloudy. All right, so let's get started here, and we'll move through I have some warm-up slides, and then I'll turn it over to Don, and he'll do his spiel, so to speak. And this is our usual disclaimer. As you might expect, we're a part of the AAII, and so anything we say here should be taken with a grain of salt, and check with your professional advisors and act accordingly. This is not, it's here for reference only and for your education. And since we're an income group, we are basically self-directed investors who want to learn from each other. And I do this every session. We are prudent investors. We're looking for a sustainable stream of income. This is really important. We're a little different than the usual investor who's looking for capital gains. This is more involved in retirement and looking for something that grows at an income rate faster than the rate of inflation. And we're, of course, preserving our capital. And typically, we buy and hold for long periods of time. This is a little chart I like to show for those that are newcomers. Typically, we try to reach out to people who are approaching retirement or in retirement, have built a portfolio of investments and now want to live off of them, with some form of stream of income based on that portfolio. So we're less interested in capital gains, more interested in a stream of steady income, hopefully at nominal tax rates and so forth. Just a little plug about our Google group. For those of you who are regular members, you know that we have a Google group, that it's available for you. We post all of the announcements there. It's a great place to discuss ideas that you may have, exchange ideas. We encourage you to post there, express yourself. You'll find fellow people there who can help you with some of your income ideas and help you. And we're a private group, so it's user friendly, and it's a closed group. It's not available to anybody but just AAI members of the Income SIG. And I always like to give a shout out to the people who are been helping us over the years with our presentations, with either presentations or suggestions. And so I've listed here a bunch of folks that I have recognized here. I probably missed somebody that I probably should have put on this list, but I wanted to say thank you to all these people for their helpful suggestions and talks and ideas and so forth. Don't be bashful about suggesting ideas. We're always looking for income-oriented speakers. So please shoot me your ideas. My email is down at the bottom of this particular slide. And this is a list of the webinars that are available at the Portland site. The first URL there is the Portland website. And as you can see, we do pretty much monthly income meetings. And they range in a wide range of topics from, of course, dividend investing is probably the most common one we do, but we do have speakers that talk about equity income, about covered calls, about bonds, utility stocks. We even have some ideas about other topics as well. So by all means, I urge you to visit this site. All the YouTube videos are there for your perusal. And so if you want to go back and look at, say, for example, what David Van Napp had to say about income investing and dividend investing, that's there. And all the other ones as well. So this is an opportunity for you to go look at some stuff there that, and we will put this recording up there as well. It'll take a couple of days to edit it and then get John Wong to post it, but we'll put it up there. All right. Todd, are you around by any chance? Are you available? I guess Todd is not available today. Todd also plays some music, and so maybe he has a gig today and so forth. So anyhow, normally Todd is our chapter president here, and he will chime in at this particular point and remind us of the next meeting. I think the next main chapter meeting is in September. I don't know for sure. I haven't had a chance to talk to Todd this week, but if you want to learn about the meetings, by all means, just visit this particular site, and there'll be announcements there for future meetings and so forth. So just visit them. Okay, just a few etiquette rules about the Zoom thing. Keep your mic off. I think the default is that your mic should be off. I suggest you also turn off your video because it might enhance your bandwidth a little bit better.
Hi, Andy. It's John. I was trying to dial on and I don't seem to have the link. If you could be kind enough, I know you're starting a meeting to Zoom the link. I appreciate it. In fact, I'll ask Colbert to send it on. So maybe you don't need to bother. Thanks.
So just, by all means, follow the rules here. It helps to make it a little faster video and so forth. Okay, here's the agenda as I have it right now. Of course, today is the 6th, and we're going to have Don do his presentation. On July 11th, Peter Lingane is going to also talk about a conservative tactical investment strategy that he has come up with. He's affiliated with the book Financial Security by Design, and I think he participates pretty regularly at the Silicon Valley chapter as well. The August meeting, we take our summer break, and so there will be no meeting in August. Gene and I are traveling to Denver to see the grandkids and have a little R&R there, as I say. And then we'll resume again in September, and I've designated September the 12th as the next meeting. And I don't have a speaker lined up quite yet, but if anybody has a suggestion or has an idea, by all means, don't hesitate to pass it along to me, and I'll get to work on it and so forth. Okay. Don is our speaker, and I will let him introduce himself and give us a little bit of background, and then let him do his thing. So I will stop sharing, Don, and let you take over there and go do your thing. Okay.
Okay. Let me get this. Let's go back here. Okay. Okay, I'll just start off here. As Andy mentioned, I'm the primary host of the Silicon Valley Computerized Investing Group, and we have other members, but let's get going. The same kind of disclosure that that Andy had. You know, these materials are educational. Please don't invest without looking, doing your own independent analysis and coming to your own conclusions. We have strategies that you could follow, but it's up to you to decide to do that. So here's the agenda that I have for tonight. We got quite a few slides, like 60 or so. I'm not going to spend the typical minute per slide. Some of them are going to go fairly quickly. But I just wanted to get the data in front of you and hit some highlights so that you'll be able to look at this later in more detail. So we're gonna, what prompted this meeting and this presentation. I'm gonna talk about the history of the Computerized Investing Group and give you some contact information if you want to join it. Then I'm gonna go over our computerized investing process. How do we go about it and why. And then I'm going to go into a recent thing that we've developed, using Monte Carlo to pick the best strategy to follow. And then I'm going to cover a couple of the basic types of strategies that we use. And then I'm going to tell you how do we use, how could you use these strategies if you wanted to. And then finally, I'll go over 5 potential strategies that could be used by you dividend investors. So how did this come about? Andy asked if our group might have some investing ideas that might work for some of you dividend investors. A lot of you like to do your own work, and this probably isn't for you, but he said some in your group don't have the time or the interest to analyze lots of individual dividend stocks, and they want a simpler approach. So he asked if there are strategies with ETFs or mutual funds that can be managed in a lot less time and provide similar or better results. And my feeling is the answer is yes. And I think we have strategies your members can use, and probably with only an hour or 2 per month worth of time. So a little bit about me. I'm the current host, like I said, of the Silicon Valley Computerized Investing Group. It was originally started by Al, and the last name. I spent, more than 30 years applying my math and computer skills to stock strategies, and I've developed software that relates to that. My background is in mathematics, and I did some PhD work in computer science, all at Stanford. So that's kind of my academic background that I'm trying to apply to the financial problem. I'm not a finance guy, I'm a math guy. Okay, Al formed this group way back in 2012. And he formed it as Computerized Investing and Mechanical Investing. I've kind of shortened it and taken the mechanical investing part of it away in the name. And basically what he was trying to do is backtest and compare strategies from all kinds of sources, AAII, the literature, and member ideas. It is a special interest group under the Silicon Valley chapter in Santa Clara. And many of our members are very analytical, engineers, computer scientists, mathematicians, et cetera. So we have a lot of really analytical people that make contributions. So unfortunately, Al passed away in 2019, very unexpectedly. He wasn't really that old a guy. And it made a lot of us sad, but some of us stepped up. And I agreed to host the meeting, and with the help of Gilbert. Gilbert is one of the guys who presented to you last week. He and I pretty much present every month, and then several of the others contribute and have helped the group keep going. I had a C# program that I'd been using, so I modified and automated that program to do testing, back testing. We now have something like 216 strategies that we're tracking, 58 market timers, and 40 some plus future strategies. And we back test them over a 21-year period of time. It takes about an hour for my program to run and generate all the data for this, and then I upload it to our OneDrive every month. Created a Monte Carlo capability to simulate random future results, and I think that helps guide us into the strategies which are the best. Some of our momentum and efficient frontier strategies have compound annual growth rates of over 30% over the past 21 years. Our market timers have been successful at reducing drawdowns. You know, we had the .com crash, we had the financial crisis, and at times there were something like 50% drawdowns during those periods. Our timers limit those drawdowns to less than 30% and sometimes even less. I also developed some future strategies that have, I say, theoretical results in the 60 to 100% per year over the 21-year period of time, although with very large maximum drawdowns, not what most people, and particularly you dividend investors, would be interested in. Our presentations are primarily given by members. Sometimes we have high-profile people come and give us presentations. Typically, we have 40 to 55 attend our meetings each month, and we're always looking for new members. Here's our contact information. If you want to keep up with what we're doing, you can join our Google group. Go to this link and join. We also make meeting announcements at meetup.com. So if you go to this link and look for computerized investing, you can sign up and then you'll get notices of our meetings. It'll show the agenda and so on. All of our presentations, our algorithm tracking, our recordings, we record every meeting, are up on our OneDrive. So you go to this link and you can see at least recordings for the past 2 years and all of our data all the way back to 2012 that Al had been keeping. So we meet the first Thursday of each month, 6:30 to 9, and by Zoom, and it's always this link. Okay, well, what is our process? We start with some idea. We can get it from literature, we can get it from the web, or maybe we come up with an idea of our own. But we have to develop rules because we want to automatically or mechanically test this with a computer program. So we basically also want to do this for 20 years. We don't want short back tests. Sometimes we do this for even much longer than 20 years, but it's sometimes hard to get data too far back. So then we write the code. I write in C#. Many of our members write in Python. Ren Curry writes in R. Peter uses Excel and sometimes C#. So anyway, whatever language you choose, you implement the code to implement the rules of that strategy. And then we run the strategy and we collect performance statistics about that strategy. And here are many of the performance statistics that we collect and calculate. And at the end of this presentation, there's a definition of all of these. We also pick a benchmark for comparison. For this particular meeting, I've picked the Vanguard Dividend Income Mutual Fund and the T. Rowe Price. The main reason for picking those is they had a long enough history to get back to 1999, so I could have a 21-year period to look at. Other times we pick SPY or maybe a 60-40 or sometimes other different kinds of metrics. But anyway, we pick a benchmark for comparison. So then recently, you know, I've indicated the Monte Carlo analysis is a very good way to look at strategies. What it gives us is I'm running 10,000 random possible future outcomes that have a similar distribution to the original strategy. And two important outputs come from this. One is the final value 90. What is the final value 90? It's the final value at which 90% of those 10,000 runs had at least that value. So it gives you a 90% probability that you'll get at least this final value. The other important output is the maximum withdrawal rate. This is the highest sustainable withdrawal rate with at least a 95% probability over some period of time. So how do we do all that? Well, we run a strategy and get its monthly returns. Then now we want to generate some random sequences. So we pick a random month end in the strategy results and take the next 3 months of returns. Why do we take 3 months of returns? 3 months preserves some of the historical structure of the distribution. Autocorrelation, some of those kind of engineering terms would be used or meaningful. And then we repeat this until we get a 40-year sequence of monthly returns. And then after that, that gives us one 40-year sequence, a random sequence, because we randomly selected from our previous strategy results. And then we repeat that until we get 10,000 of these 40-year return sequences. Then we start with $1 million. I mean, that's just an arbitrary number. We start with $1 million, and for each of those 10,000 40-year return sequences, we use the returns to adjust the portfolio value. We withdraw funds monthly at some withdrawal rate, example, 4% a year. So 40,000 starts off at 40,000 if you have a million. You're withdrawing 40,000 a year and you're inflating it at 3% a year. And then after we've done all that, we finally get to a final value for each of those 10,000 runs. So then we sort those 10,000 final values from the lowest to the highest. So then to find the final value 90, we go up to the 1,000th point of those 10,000, and that point is the final value 90, because 90% of the points are that much or higher. And it's my feeling that the strategy with the highest final value of all those that you tested is the best. I'll get into more about why you might want to not pick that one at a particular point in time, but for now, that's what I think is the best. Now, to find the maximum withdrawal rate for some period of time, you start with a 1% withdrawal, and you go through all 10,000 runs with a 1% withdrawal and the 3% inflation. And if more than 5% of those 10,000 runs run out of money, then you've gone too far, so you have to stop. Well, if it makes it, then you add 1% and go use a 2% withdrawal. You keep doing that until finally you get to the point where you can't pull out enough money without getting more than 5% failures. So this will be the with maximum withdrawal rate with a 95% confidence level. Here is a chart which shows these 10,000 runs sorted from the lowest to the highest. And I stopped at the midpoint here because this particular one is way too good compared to all of these others that are in this chart. So on the bottom here is the final value in millions of dollars. And this column, this vertical axis shows a percentage of the samples. So this is the 10% point, the 0.1% of the sample. So wherever this line crosses, that is the final value 90. So you go down here and whatever that value is at the 10% crossing point, that's the final value 90. And so it would be hard to read it here because they're all clustered together. But you also get this table. So this table shows all the strategies. This is just a sample, and you look at this 10% column, and this tells you the final value with a 90% confidence. So this first strategy here would have had 871 million, or 871 times whatever you started with, after 35 years where you withdrew 4% and you inflated at 3%. And these are all what all the strategies would have done. And this data is in a file called Final Value 70 that I upload on the website. The maximum withdrawal rate is a similar sort of thing, but this time you're focusing on the maximum percent column. And this says that if you go 35 years, you're going to test from 1 to 30%, you know, and you'll stop when you have more than 5% failures. So this first strategy, for example, you would have been able to pull out 11% per year for 35 years and have 4.2% of those fail to make it to the end. And then this would be how the rest of them would have performed. So you see several of these down here could not even make a 4% withdrawal rate. They only could get up to 2%. So you're going to see that some of the benchmarks that I picked cannot, you know, have a maximum withdrawal rate of more than 2%. So not so good. And if you had invested in SPY or QQQ on their own, they also wouldn't have been able to sustain a 4% withdrawal rate. So how do you use the Monte Carlo results? We're going to do all this analysis for a 65-year-old. We assume you're 65 and just retired. So how long do you need your funds? Well, I say you need your funds for another 35 years to cover 96 to 99% of your possible lifetimes. And I say plural in case you're married and you have a spouse, which can be considered their needs for that lifetime. We're going to assume a 4% withdrawal rate, which is typical. Typically, they say that's, you know, kind of the maximum you can use, and we're going to inflate it by 3% a year. And I always put this note in here because around Silicon Valley, assisted living can be super expensive. So I just say, don't underestimate your potential withdrawal needs. So let's look at the life expectancy of a 65-year-old, both a male and a female. So this is a link to the actuarial tables that the Social Security Administration gives. So these tables start with 100,000 lives at time 0. And so at 65, only 79,000 males would be living at that age. 87,000 women would still be living at that age. So 79% chance of making it to 65 and an 87% chance for females. So the median life, remaining life, would be you take half of this number, and the age that you get for that is around 84. So about 20 more years is your 50-50 chance of making it to the end. And for a woman, 86. Now you ask the question, what is what are the chances of living to 100? That gives us that 35 years that I was talking about. Well, only 958 out of that 100,000 will make it to 100. So when you take that number divided by your 79, there's only a 1.2 chance, a percent chance of making it to 100 from 65 for a male, and a 3% chance of making it for a female. And then if you want to say, what is the probability that both don't die before at least, i.e. at least one is living, there's a 4% chance that one of you will still be living at 100. So that's why I picked 35 years. That covers anywhere from 99 to 96% of your lifetimes. So given all of that, you would go to this final value PDF file that gets uploaded. you would use this particular table, the one that's 35 years and with a withdrawal rate of 4% or whatever percentage you needed. And then you would find the strategy with the highest final value, 90. If you wanted to know what your maximum withdrawal rate was, you'd go to this file and you would pick this table, the one with a 5% failure, and you would find out what the withdrawal rates were for each strategy. So anyway, so now what we're going to cover here is what are some basic types of tactical asset allocation strategies, the kinds of strategies that we typically use in our work. The first class of strategies would be momentum strategies. So what do? You pick a universe. The universe is the collection of stocks that you're going to consider. It could be the NASDAQ 100, all 100 stocks. It could be like these 3 stocks. It could be the S&P 500 Dividend Aristocrats, or it could be any set of ETFs that you wanted. So you're going to pick a universe, and now you have to pick a way of ranking the members of that universe. So here are some of the ones that we typically use. This monthly gain of 12 is the previous 12-month gain using month-end dates. Fundex is another ranking system. So the way you do that is you calculate the previous 1-month gain, the 3-month gain, the 6-month gain, the 12-month gain, and you divide by 4, and that gives you its Fundex ranking. And then another would be DEMA 30, which would be a double exponential moving average with an alpha of 1/30. And I'll get into more of that, but there are all kinds of different ranking algorithms that we can use, but this was a few of them. Then you pick the number you wish to invest in each month. Could be 1, 10, 5, 6, any number that you want to invest in after you've ranked. Optionally, you can pick a market timer. A market timer is an algorithm that tells you when to get out of equities. And we have some 58 market timers that are currently up on the website. And here are a couple of them. You could use a simple moving average monthly 8 months of SPY. And if the current price of SPY is less than the average of those past 8 SPY prices, then you get out of equities. That's the way that market timer would work. This one is a little more complicated. It's an absolute momentum timer with 2 different periods, a 5-month and a 1-month, and you use SPY and T-bill. So you compute the absolute momentum of 5 months of SPY and T-bill and the absolute momentum of 1 month SPY and T-bill. And what that means is it's the 1 month or the 5-month gain of SPY minus the 5-month gain of T-bill, or the 1 month gain of SPY minus a 1 month gain of T-bill. And if either are positive, you're stay in equities. If both are negative, be in cash. Anyway, we have 58 of these different timers. Those are just a couple of them. Then at the end of the month, you rank the stocks in the universe, and with whatever ranking algorithm you had picked up here, and you invest in the top end. And if you're using a market timer and the market timer says be out of equities, then you invest in some cash asset that you had picked. It could be money market, T-bills, short, intermediate, long-term bonds, or leverage bonds. These would be some of the examples that you might use. So that's basically how momentum strategies work. Another class of strategies that we use are called efficient frontier strategies.
Can we stop for a second here and ask for questions from folks? Would that be okay?
Sure. Yep.
Anybody have any questions because this gets he's getting a little technical here, and I want to make sure everybody understands before we move forward. Any questions? Unmute your mic and ask a question, or use the chat function to type in your chat features. don't be bashful. You know, we encourage that. So.
Okay, well, I mean, if there are no questions or it's too complicated, we'll keep going. This one gets to be even more complicated than the last one, so we might get some more questions here. So these are, this second class that I'm going to talk about are the efficient frontier strategies. And I don't know how many of you've heard of modern portfolio theory and efficient frontier. I'm going to try to explain it here and we'll see how we do. I've got a picture also on the next slide. So again, we pick a universe. This time I'm going to just focus on SPY, QQQ, the NASDAQ 100, and long-term bonds, TLT. Now, the next step for this strategy is you have to pick a portfolio standard deviation target, you know, something you want to limit the portfolio standard deviation to this target along the efficient frontier. And so I'm going to pick for this 0.7% daily portfolio standard deviation. So at the end of each month, you find the mix of assets of these three, which give the highest return at that particular PSD target. And it's a point on what they call the efficient frontier at that target. So the inputs to the solution, you know, might be a little complicated for some of you non-engineers, but what it is it's supposed to be an estimate of the future covariance matrix. Well, we don't have a crystal ball. So what we typically use is the historical covariance matrix, and I use the past 105 daily returns of each asset to compute the covariance matrix. So for 3 assets, you would get a 3x3 covariance matrix of, you know, all possible pairs of those two. And the other thing you need is an estimate of future returns. Again, we don't have a crystal ball. You know, if we knew both of these exactly, the world would be great, but we don't have it. So we use the best we can come up with. So we use the average of the previous 63 daily returns of each asset. And then for the particular algorithm that we use to find the solution, there is a variable called risk tolerance. When the risk tolerance is set to 0, this gives you what's called the minimum variance solution. This is the absolute lowest portfolio standard deviation that you can get with those 3 strategies at the end of that month. So we use William Sharpe. You know, he was a Stanford financial guy, Nobel Prize winner. I've found on his site an algorithm called the 2-asset swap algorithm. And it solves this Markowitz quadratic optimization problem. And if you go to this link, you'll find code in Python, R, and the original he had was MATLAB. And there's also a write-up of how all of this works if you want to really dig into it. But I'm not going to go into it because it's a little bit complicated here. I'm going to now show you what an efficient frontier looks like for those 3. So this basically is showing for the combination of SPY, QQQ, and TLT, if you were to, the efficient frontier is the curve that goes kind of like this. And I've only shown 1, 2, 3, 4 points on that efficient frontier. There are points all the way along in between. There should be a continuous line. But let me show you, this is called the minimum variance. The axis here is the daily portfolio standard deviation. So this is 0.6%, 0.7%, 0.8, 0.9. And this is what I was calling the minimum variance solution, because this is the lowest with those assets that you can get a portfolio standard deviation to be. And this says that you would need 44% SPY and 56% TLT to get to that minimum variance solution. I was looking for the one at 0.7%. So the 0.7% solution would be 71% SPY and 29% TLT. And if you wanted to find out what the solution was at 0.8%, it would be 88% SPY and 12% TLT. And then finally, when you get way out here on the efficient frontier, it all goes to 100% SPY. There is no TLT involved, and this happens to be the maximum Sharpe point, which is the return at that point minus risk-free return divided by the standard deviation. So it's 0.14. So that's what an efficient frontier looks like. And all of that stuff that I just told you on the previous slide is a way that we solve it and get a result. So how do you use our computerized investing strategies? On the last market day of the month, I upload all the stock picks and allocations for all the 200 strategies, and it's on our OneDrive at this link. And so you would go to this folder called algorithm tracking, and whatever the last, like for this past month, it would be 21/05/28, and that would be the folder you'd go to. And in red here, just like I said before you try to use any of these, you really independently have to review and come to your own conclusion about whether or not you want to do this, because you're doing it at your own risk. The data is provided, but it's your choice to do it. Some of you, I think I've seen, have some experience with Portfolio Visualizer. Many of our strategies, not all, but many of our strategies could be replicated and verified at Portfolio Visualizer. So I would suggest, if you're interested, go to Portfolio Visualizer, try it out, and you can independently verify. Bottom line is, given this data is up there at the end of the month, it should take less, only 1 to 2 hours per month to implement one of our strategies. Here's an example of what that allocation file would look like. So this is the month ending. This would be there would be 200 and some strategies that would be presented. And this would tell you what you should be holding and in what percentages. So for example, all of the benchmarks that I had, it's saying I'll be 100% in those particular benchmarks. If you're investing in the NASDAQ 100 top 6, these would be the top 6 NASDAQ stocks to invest in, and these are the percentages that you would invest in each one of them. If you're investing in this one, you'd be 100% in SPY. Now, you would say, well, I thought your last chart showed that there should be some in T-bill. It turns out that this algorithm has been overridden because bonds were doing so poorly after about August of last year. So now long-term bonds are not allowed to get into these strategies until bonds get back into a more normal state. So the dividend aristocrats, if you were to rank by this particular one, take the top 10, use this timer. The timer is not firing, so it would say invest 10% in these top 10 dividend aristocrat tickers. So I'm not Exxon I'm familiar with, Caterpillar I'm familiar with. I'm not familiar with too many of these, but this is what you would invest in that particular strategy. And this simple here, this one I'll get into later, but this is basically saying be 50% in US stocks, like, all US stocks, and 50% in your international stocks, ex-US. So I'm going to go through some nomenclature because it's going to be a little complicated. So the nomenclature is typically some ID, the universe name, the ranking algorithm used, how many top end you're going to pick, what the weighting factor is, are you using a market timer or not, are you using a stock timer, and in this case, we're not going to be ever using a stock timer. And then what is the ticker you're using for cash if the market timer says to be in cash. So for the benchmarks, I'm using this T. Rowe Price dividend growth, and this one is just straight. And the second one is T. Rowe Price, but now I'm going to use a timer on it to show that the timer can actually improve the performance of the basic. And then I'm going to do the same thing with Vanguard dividend investment. And I'm going to use the same timer to improve its results. And then I'm going to show 5 of our strategies, which I think could be used by your group to simplify your life and get returns that are equal or better than any of these benchmarks that we've come up with here. So I'm going to go into each of these separately next. So, okay, let's start with the first one. So the universe is the NASDAQ 100, and I say true history because as you go back in time, the stocks in the NASDAQ 100 change. So this uses the 100 stocks in the NASDAQ at that particular end of each month. So those are the stocks that we're going to be ranking each month. And we're going to use that Fundex monthly. So it's the 1 month gain, the 3 month gain, 6 month gain, 12 month gain, previous gains, previous 12 months, and divide by 4. So all the 100 stocks that are, sometimes there's 103, but typically we'd rank all of those stocks, and then the highest Fundex ranked stocks, the top 6, we would invest in, and we would invest in equal weight, 1/6 in each of those stocks. And then we will use that market timer that I talked about before. That's the absolute momentum timer, 5 month, 1 month, using SPY and T-bill. And this kind of explains again how we use that. If this market timer says be out of stocks, if both are negative, it'll go to T-bill. So that's the first strategy of the 5. The second strategy of the 5 is just investing in SPY, the S&P 500, just on its own, and using a timer down here. So the ranking is no rank. It's the top 1. So we're just, going to pick it. We're going to invest 100% in it if the market timer says to be in equities, otherwise it'll be in T-bills. And we're using this StormGuard Armor timer from Sector Surfer. The timer values can be downloaded here. If you go to this link, once you get this document, if you click on this link, it'll go to sumgrowth.com, and you can download the signals. And anytime it's less than 0, you're out of equities and into T-bills, and otherwise you're just in SPY. So very, very simple strategy. You're mostly in SPY. Once in a while, you're in T-bills, but that's the way it works. So very simple. The next one is Dividend Aristocrats. Universe is the S&P 500 Dividend Aristocrats. Now, I subscribe to Norgate data, and Norgate provides me with a list of the Dividend Aristocrats each month, all the way back before 1999. So somewhere between 20 to 60 stocks are in the Dividend Aristocrats in the S&P 500. So now I'm going to use this particular ranking system, which is the double exponential moving average of using 50. So alpha in the algorithm is 1/50. So how do you calculate this thing? Well, you start off at 0 and you set them both to 0, and for each I, it's alpha times the daily return plus 1 minus alpha times the exponential moving average 50 of I minus 1. So you start at 1, and this is V0, so you have 0 to start with. Then the DEMA 50 of I would be alpha times the EMA, this one, of I, and 1 minus alpha times the DEMA 50 of I minus 1. So this is a way you calculate that, and then the ones with the highest ranking are of the top 10 are the ones you pick, and you equal weight them 1/10 in each of those stocks, and you use that same timer that I talked about before. And if it's negative, you go to T-bill. So this one I thought might be of interest to you guys because it's using the Dividend Aristocrat stock. So it's each month is telling you which 10 to invest in. And so you might be jumping around a little bit, but we'll test this algorithm, see how it works.
Donna, what are you doing with the dividends in these criteria?
Well, I'll kind of show you that later when I get into the taxes and the dividends. I actually keep track of the both qualified and ordinary dividends of each of these stocks, and so I tally all of that, and I'll show you all that later.
Okay.
Here's that universe which uses the efficient frontier strategy. So the universe is SPY, which is S&P 500, QQQQ, which is NASDAQ 100, and TLT, which is long treasuries. There's no ranking algorithm because we're going to use the efficient frontier algorithm. So we're looking for a daily portfolio standard deviation of 0.7. I showed you the chart of how we go about that, but we do that every month. And so the covariance matrix changes every month and the returns change every month. So anyway, we've just find the combination. There's no market timer in this one, and there's no cash stock because we basically have a cash type asset in the universe. So once in a while it can pick that. So the next one is, this is a simple strategy that Peter Lindgain has come up with. I'm using a slight variation of this because I wanted longer history that was easily available. Originally, Peter used VOO, which is S&P 500, and VNQ, which is REITs, and VEU, which is FTSE all world except for US, and IEI is 3 to 7 month treasuries, and VFISX is short-term treasuries. And so my variation, I use this mutual fund, which has a total US market instead of VOO. I use this one for REITs. I use this one for the FTSE all world except this. And then I use 5 to 10, so slight deviation from what he was doing, a little longer durations for the treasuries. And then I have the short treasuries here. So this one uses the Fundex ranking, which I've described before, the 1, 3, 6, 12 month returns summed together and divided by 4. And it takes the top 2 out of these stocks based on Fundex, and then invests a half in each of the funds. There's no timer since bonds are in the universe, and so no cash stock. Okay, so now we've got four different benchmarks. We've got 5 different strategies. I'm going to do 2 sets of runs. One run will be no taxes and no withdrawals. And this is similar to having a Roth account, which has no taxes, and before you're actually retired and before you're taking withdrawals. The next set of runs will be Fed and state taxes. And I'm using single rates for both, not married, but single rates. I'm using 2020 federal and Oregon state tax rates. Now, I didn't adjust the tax rate ranges over time, so it's a little bit of a pessimistic analysis because those rates would, go up a little bit like CPI or something. So you would be actually having a little bit less tax than what I'm showing. But on the other hand, I'm only going to be paying the taxes one time a year in March for the previous year. So I'm not going to have quarterly withholdings or any of that. So I'm going to end up having to pay a penalty, which I didn't actually put into these runs. So I think those two might compensate a bit, and later on I'll maybe fix that. So I'm going to do it for a taxable account. And in that taxable account, I'm going to keep track of ordinary and qualified dividends, because qualified dividends get the long-term capital gains treatment, and these get, the standard income treatment. Of course, for state, doesn't matter which, but for federal, this makes a difference. And for an IRA account, we're going to tax the maximum of the inflation adjusted withdrawal. You start with 4% and inflate by 3%, or the required minimum distribution. And those will be treated as standard income tax rates. So you don't get any of the benefit of the qualified dividends for federal or anything, because you're just pulling money out of an IRA. And so you're having to pay standard income tax rates on all of that. The excess funds withdrawn due to the RMD, if there are any, if after you've paid all of your expenses, will be left in an uninvested taxable account. And only in a few cases, I'll show you later, that this will actually be the case. And in some cases, a whole lot of cash ends up there. I'll go into that, like I say, a little bit later. In the Roth account, there will be no taxes, but I did take the withdrawals from the account to, for living expenses or withdrawal. So as I said, these are the benchmarks we're going to be using. One, just this particular mutual fund all by itself, and this one with the market timer, and this one all by itself and with a market timer. So here's what the results look like when you go 35 years with a 4% withdrawal and a 3% inflation. You notice down here that B1 and B3 didn't even make the cut. It turns out that they cannot go for 35 years with a 4% withdrawal rate and make it to the end. So they got dropped off of this table. The ones with timers were able to make it. Of course, this is one, this has been one of our, I think I came up with a strategy like, I don't know, 5-6 years ago, maybe. I forgot exactly when, but it's been one of our top performers. And see, this has like a 28.6% CAGR over the 21-year period of time. And this says that you would have 871 times whatever you started with after 35 years, even pulling out 4% a year and inflating it by 3%. And the others were a lot less, but still, all of them say that you would have at least what you started with or more. Now, these numbers are not inflation adjusted numbers. These are actual numbers. So the buying power of those after 35 years would maybe be only one, you'd have to divide all these by 1.8 to see their actual buying power. Maximum withdrawal rate of all of these strategies. So again, this best performing strategy was the 11% maximum withdrawal rate with a 4.2% failure rate. This efficient frontier strategy with SPY, QQQ, and TLT had a 7% withdrawal rate, meaning that you could pull out 7% per year, inflated 3% per year, and only have 2.7% failures out of those 10,000 runs. And these are the rest of the numbers that you'd see. Now, here it's showing that this is the 1 and 3, the ones without timers, the benchmarks without timers. only could pull out 2% a year. That's why they didn't show up in that previous table, because you couldn't pull out 4% a year and make it to the end. So they got excluded. All of these that are less than 4% got excluded from the previous table. So I'm now going to kind of show in a little detail what all these lines mean. The red line is, in this case, the T. Rowe Price mutual fund. And this is the way it looks if you just invested in this and just held it, this kind of buy and hold for the whole period of time. The green line is SPY. So it was outperforming SPY here for a while, and then SPY started catching up. And then the blue line is the NASDAQ 100. So it was down here and now it's catching up. Now this black line in this particular chart, it's the red line divided by the green line, because we're comparing to SPY in this case. And so when this line is going up, this is called a relative strength curve. When this line is going up, it says that your strategy is outperforming your benchmark. And when it starts coming down, like it is here near the end, and it's just barely above 1 here, so it's still above SPY, but just barely. So it got ahead up back here, but it's been losing the advantage over time. So that's basically how you read this chart. And down here at the bottom is the top part of this chart is the percent you're in cash. And in this case, there's no cash. You're 100% invested for the whole time. And this is also showing the drawdown. So the drawdown of this particular strategy is like, this is a daily drawdown, it's like 52%. So if you're in this stock or this mutual fund without any timer, sometime during its lifetime, maybe in there or whatever, right here, maybe the financial crisis, it was down 52% from a previous high. So not so great. So now let's look at the next one, which shows the same thing only with a timer. Okay, now look at the red line now. All of a sudden, and this is showing when the timer is firing. When this goes to 100% cash, that says the timer is fired. And when it's back down here, you're fully invested. So this got out during the dot-com bust. And so the black line you're seeing climbing pretty good. And then it's going along. And then rather than crash like it did before, you're out of the market here. You're just staying in cash. And then you continue on up. So now this red line has been improved significantly. The maximum drawdown now is, rather than 52%, it's only 19% due to that timer. So this mutual fund, your benchmark with this timer, all of a sudden has a better return and a much, much lower drawdown. We're down to -19 versus -50. So a significant improvement. So now we'll go to the next one, which is the DVIGX, which is a Vanguard dividend growth. This one had a 47% drawdown, so similar kind of characteristics. It actually underperformed. This time we're comparing to to the primary benchmark, which is the T. Rowe Price dividend growth. And so it was underperforming what T. Rowe Price was able to do, but it was still down 47%, had a 6.7% CAGR. And now let's look at what happens when we put a timer on it. Wow, now it goes up to 9% CAGR. The red line's looking much better. 9% CAGR and only a 16% drawdown. So, a possibility. And so, but now we're going to go on and see how the strategies are computerized investing strategies compare to all of this. So now this one is, this one is an aggressive portfolio that has done super well. That's the 28.6% CAGR, and it's got a 49% drawdown. But that's daily. Monthly, it does a lot better. But this yellow line is the comparison to this benchmark. So this is basically saying this strategy outperformed the benchmark. It's 32 to 128. So somewhere between 32 times better to 128 times better. I don't know what this number is exactly, but much better than the benchmark, which is the T. Rowe Price, the dividend growth. And but recently it's not been performing super well. It's dropped. The NASDAQ 100 has been suffering here lately. So we'll talk about that a little bit later. Okay, here is the timer. This is the SPY, simply timed with a StormGuard Armor timer. And it had a 12.5% CAGR and a 15% drawdown. But look at this curve. You could just, that is a nearly straight line up. Very, very safe. And you're only in SPY, you're not in leveraged or anything, but you're just doing super well and having a very smooth curve, very low drawdown. So this is another one, that's a totally simple strategy to implement easily. I mean, most of the months you would look at it, if the timer is still saying being in equities, you don't do anything. So it's like zero. I mean, maybe the 5 minutes to make sure that you're not timed out. So very simple strategy to implement. The next one is a dividend aristocrats strategy, where you're ranking with this and taking the top 10. It had an 11.3% CAGR and a 24% drawdown just by doing that simple strategy. It is performing at something like 2 times your T. Rowe Price benchmark. You look at the 2, go out here, the yellow line is a little above 2. So this is 2 times your benchmark. And the next one is, this is the efficient frontier strategy with a portfolio standard deviation target of 0.7%. It has a 14.1% CAGR and a minus 18% drawdown. This is an even better curve than the simple StormGuard Armor curve. And so it's up here at nearly 4 times the benchmark. You look at this gold line, and it's roughly at the 4% or 4 times CAGR. Now we go to the simple strategy, Peter's strategy there, my variation of it actually. It has 11.3 CAGR and a minus 20% drawdown, and it's got a very nice upward curve, this red curve, and it's a little over 2 times the benchmark. So again, all of these are outperforming the benchmark significantly. Okay, so now we're going to go into what happens if we tax these strategies. I didn't have 21 years of history, so I'm only going to use the 21 years of history we have. I don't have the, I didn't have the ability to do the Monte Carlo analysis when taxes are involved. So this is going to be, we're going to have to use some judgment here because we didn't have the 35 years required for a lifetime, for our lifetime from 65. So if a strategy value is declining, probably not going to make it for 35 years if you need it. If you're one of the few people that are able to make it to 100. If the strategy value is increasing, probably you'll make it, but not totally confident. So the tax, what we do is the tax is the additional tax due to investment. So we'll compute the tax with investments and subtract the tax without investment. So I just wanted to make that clear. This isn't your total tax. This is the tax, the incremental tax above what the tax would be without the strategy and, you know, the results of the strategy. I assumed a base income after standard deductions or deductions of 25K, maybe not enough in some cases, maybe more in some other cases. So at the end of March each year, I take out the withdrawal, the full withdrawal amount. I don't incrementally take it out each month, which would actually be better to do, but I take the whole withdrawal amount for the current year and enough to pay taxes for the previous year. So like I said before, because there's no tax withholding, you would be incurring an underpayment penalty, but it's not too much. I think the fact that I didn't increase the tax ranges will compensate for that. So it's a little bit of a wash. So what happens? You know, what does it look like? What kind of results do we get after 21 years? Well, here are 4 benchmarks, and here are 5 strategies. And this is the final value of the portfolio after 21 years, where you took the withdrawals at 4% withdrawal and a 3% inflation. So the first benchmark, you ended up with 781,000 and you started with $1 million. So you see it's going down. So you're starting to wonder, is this going to really last for 35 years? And probably not. And then the next one, you actually grew a little bit because of the timer. And the next benchmark, you're really losing value. You're only down to 360. And then with the timer, you come up a little more. But now the next ones, and the darker green is the best and the other greens are very good. But look, you end up with $16 million after 21 years using this strategy. And all of these are better than any of the benchmarks. Every one of these final results are better than the benchmarks. And this way over here are the tax totals that you pay. So I won't go into this much, but let's go on to the next. I'm gonna, a lot of data here, but I'm just gonna try to highlight, show you some things, and then I won't have to do it on every one of these cases. So in this case, we're just looking at the final values. These columns here are ordinary and qualified dividends. So this is showing you for this benchmark, which is, you're 100% invested in for the whole period of time. This says these would be the amount of ordinary dividends you would be paying taxes on. These would be the qualified dividends you'd be paying taxes on. And this shows you that you start, let's say you're 65 in 2000, you start at a withdrawal of 40,000 per year. Next year is 3% more. And by the time you get 21 years, you're pulling out 74,000 a year. And these would be your total taxes. Now, you'll say, well, how can you have negative taxes? Again, remember that this is the tax, incremental tax of the effect of the investment over the base tax. So because you had a loss here, you were able to actually gain over, you get that little 3,000 off or whatever. So anyway, that's the first one. This is the second one. I don't need to show anything here except that, it was growing. In the past case, it was lowering over time. This one is, let's see here. This one is the NASDAQ 100 strategy, and it's just growing like gangbusters. Although, and look at this, you paid $12 million in taxes over 21 years, but you're still ending up with 16 million. So you still came out ahead, even though you paid all those taxes. This one is, you know, it did okay. Okay, so those are just a couple of them. So now I'm going to go to an IRA account. And this IRA account, same sort of thing. We're using a 21-year history, not the 35. We withdrew the maximum of the inflated withdrawal amount. And in this case, we're going to consider required minimum distribution, the RMD. If your portfolio is growing, this is actually going to turn out to be a higher number than your inflated withdrawal amount. And I'll show you that in a minute. So what I said is, if there is an excess withdrawal amount, if you had money left over after you paid taxes and had your living expenses, they were put into a cash account and not invested. In some cases, if you had invested that, you would have much higher returns, but I didn't do that for this case. And again, the tax is the additional amount due to the investment. So you take the tax with the investment minus the tax without the investment. And the same thing, took the withdrawal amount out for the current year and enough to pay for taxes for the previous year. So in this case, with the IRA account, boy, by 2021, you were down to $40,000 in this account, this first benchmark account. So in 2022, you would have run out of money because at that point you were needing like $70-some thousand. So you knew you were going to run out of money. This one, you still had, you know, it still had grown a little bit, but here with the Vanguard dividend income and growth mutual fund, it ran out of money in 2019. So we stopped with 70,000, but in 2019, when I had to pull out the withdrawal amount and pay the taxes, it went negative. So it failed. It actually failed to even make it 21 years in an IRA account. And the rest of them, they were doing well. And now in the IRA account, this one is even doing better. It's up to 76 million. And it's got, look at these, all of these now have had excess withdrawal amounts because of required minimum distribution. And so you've got all this money sitting in a cash account uninvested. So I'm going to show a little bit of the detail of that in a sec here. So this showed how your first benchmark started with $1 million, and boy, it's just dropping, and it's down in 2021, it's down to 40,000. And next year, you're going to be pulling out more than 70,000. So, you know, in 2022, an IRA retirement in this particular mutual fund would not have given you enough funds for more than 21 years. So the next one, this one grew a little bit, and the thing I want to point out here is that this is your increasing withdrawal rate starting from 40,000 inflating at 3% a year. But this is your required minimum distribution. So, you know, after you get to 70, you'd be 70 here. Say you start 65 here, say you're 70 here. Here it calculates your required minimum distribution. You know, you use the table and look all this stuff up, and I did that. So here you're actually needing to pull out more than the required minimum distribution. So you're all fine here. But the minute you get to this point, like 2014, all of a sudden your required minimum distribution is actually higher than what you would need to live on. So now you're pulling out extra money, and but you still had to pay the tax from last year, so you still don't have any money left here. And But anyway, so this is showing that all these months here, you're actually already pulling out because of RMD more than you would have naturally pulled out just for living expenses. So you are having some excess here. This one was the other benchmark without a timer, and it runs out of money, like I said. And actually, it still had money in 2018, but 2019 it ran out of money, so not good. This one is with the timer. It increased a little bit, but now look in this case. Way back here, you started pulling out more than you had to because of required minimum distribution. And starting in 2014, you actually, you pulled out 95,000. You had to spend 60,000 to live on, and you had to pay 21 million $1,000 in taxes. So you still had 13,000 left over. So you start having some that's going into this cash account, and it's just sitting there uninvested. But even this particular benchmark with a timer was having money left in a cash account uninvested. Now you get to, this is our super performer. And because it's performing so well, you start putting cash even way back in 2005, you're putting cash. So at the end, you have 11 million just sitting there in cash, and you have 76 million in the IRA account. So the sum of these two is like what, 87, 88 million. And all of these years, look at how much you're having to pull out just due to RMD. When you get down here, you had to pull out nearly 6 million just due to RMD for this IRA account because you had so much money in there, way more than what your living expenses were going to be. So anyway, that's why I'm highlighting these things in yellow. Okay, this is another example of one of our good strategies. Again, it also has some leftover, and it has many, many years of RMD being higher than what you would need to pull out just to live on. So you're actually having a net increase in your cash account. So at the end, you have 5.5 million in your IRA account, but another 800K just sitting there in cash. Okay, so now that was it for the IRA. Now we're going on to look at what happens in a Roth account if you invested these strategies in a Roth account. This time at the end of March, all you have to do is take out the withdrawal amount for the current year. There are no taxes you have to pay. So this one is going to be our best possible case. So all of you guys or people with Roth accounts, this is a good place to invest. So, again, with a Roth account, you're still in these first two. I kind of highlighted them in pink, showing that they're losing money. This one wasn't losing too much. This one's losing a little more. So it's a question as whether or not it's going to last for 35 years. This is only 21 years. But this high performer, when you don't have to pay taxes and you just get to grow at a 28% or whatever it is per year, except you do take out living expenses, you end up with 159 million after 21 years. It'd be even more. But all of these, again, are better than any of the benchmarks, and significantly better than the untimed benchmarks. These would be typically your real benchmarks, the ones in pink. These are assisted benchmarks, with the help of computerized investing. We added a timer to help improve. So there's not going to be too much to show here. This is the first one where it's actually still losing money just because you're having to pull out a lot to live on out of your Roth account. This one, a little bit better. Again, this one is your dividend, your Vanguard and benchmark, and it's really dropping. And then that's with the timer, 3,000. And now this is how the NASDAQ 100 does. It starts growing pretty fast here. And it's, look at this, 2017, you had a $10 million long-term gain. That was nice, but you had a 13 million short-term gain. So had you had to pay taxes, it would have been significant, but you end up with 159 million. So this is the efficient frontier strategy. It got up to 9 million. This is a summary of all sorted by CAGR. And these are CAGRs after taxes and withdrawal rates. So bear in mind that these aren't like, these are basically growth numbers after taxes, after living expense or withdrawals have been taken out. So this still had like a 26.8% CAGR. And, so these are the top ones. I highlighted them in yellow. And then for the past, how have they done for the past month? They weren't up too much this past month. Look at this, dividend aristocrats were up 6.8% last month. Year to date, dividend aristocrats are up 19%, probably one of the best performers here. See the NASDAQ, remember I was telling you, even though Monte Carlo said NASDAQ 100 was the best, recently it has not been performing like year to date. This particular NASDAQ strategy with the taxable account is down like 20%. So, what I wanted to do here is look for those strategies which, have been doing well the past month, the year to date, and maybe this is like a year and a half. So some of these strategies, like the NASDAQ, if you looked at the last year and a half, it's up 85% compounded. So that's why, in general, this is a really good strategy to be in, but it's just not a good strategy lately. And some of these others are still, these are respectable CAGRs for a year and a half worth of history. And the dividend aristocrat here is up 24% compounded for the last year and a half. And then, so another thing I've done lately, which I'm just starting to develop, is the same way we rank individual stocks by some ranking algorithm. I said, what happens if we rank the strategy by a ranking mechanism? So this particular one is, the way you read this is, it's a 1 month, 1 times a 1 month, 1 times a 3 month, 2 times a 6 month, and 0 times a 12 month. And then you divide by the sum of those 4. And so when you rank the strategies on that basis, you find out that the NASDAQ 100 have not been doing too well recently, but all of these in yellow have been doing well. So I would say, first of all, be aware that this is the best way from a Monte Carlo point of view. All of these high performers typically do well. All the high CAGR performers typically do well on Monte Carlo. But what have they been doing for you lately? And so I would tend to want to highlight the ones that have been doing well for you lately and invest in those if you had to make a decision. So I'm going to summarize all of that next. So the current best, in these taxed accounts or the various kinds of accounts. For a Roth account, all of these seem to be doing well now. The NASDAQ 100 is excluded out of that. So 4 out of the 5 are doing well. Any of these could be viable candidates if you wanted to invest in a Roth account. If you wanted to invest in an IRA account, maybe these 3 would be the best for consideration. And if it was a taxable account, these 3 would be the best for consideration. So I hope I've gone through that fairly quickly, and there's probably a lot of really new material for a lot of you, but hopefully I've gone slow enough that most of it has been able to sink in. All of this data will be there. Andy has these slides, and he will make them available so people can get to the links and everything, and you can analyze that data in more detail later. But the bottom line is the 5 strategies that I showed you, and this is just 5 out of 216, I think we have now, something like that, and 58 timers. All of our strategies had higher CAGRs than the benchmarks, even the improved benchmarks with our timers. They had lower maximum drawdowns, they had higher final value 90s, and they had higher maximum withdrawal rates. And all of these strategies can be implemented once a month in 1 to 2 hours per month. And the other thing is that basically the way I implemented these strategies was in March, I sold assets. I sold assets from the portfolio so that I could generate enough money to pay all the taxes for the previous year, and additionally pull out enough money to live for the current year. And so basically, I generated the needed cash flow just by selling assets, and I didn't have to depend on dividends for cash flow because I was using the total return of the portfolio as a cash flow asset. So that's it for the presentation. I just wanted to show you a couple of things. I won't go over it in detail, but I mentioned that at the end of this presentation, all of these metrics that we compute, I give them a name and I tell you how they're calculated, so you can go back and review all of this so that you know what the benchmarks are. And this is kind of another little summary chart that shows what maximum drawdown is. You look at a previous high, and when this gets the lowest, that's the maximum drawdown. I mean, you have drawdowns, but the maximum drawdown is the worst of these overall, the period. So anyway, that is it. And I'm ready for any questions.
Tom, you want to go over, I don't see too many questions here, but Tom, do you want to paraphrase some of them, or if anybody wants to unmic themselves or unmute their mics and ask a question? I'm sure Don would be happy to help with that.
Sure, there are a couple in there. And I'm not sure they're questions. They may be comments, but one is, retired people like simple strategies. Your benchmarks with timers look promising. What about VHYAX or similar high yield dividend mutual funds and ETFs? Are mutual funds better than ETFs, or vice versa?
Well, when for that one strategy, I picked mutual funds because they had history all the way back to 1999. I'm not familiar with these particular mutual funds that Richard is identifying here. I could, it'd be easy for me to put something like this in and make a run, but, not just right off the top. I mean, I don't know what the answer would be without running it, but I have, you know, my program basically is a form type program, so I can put in a universe of stocks. I can select a ranking algorithm. I can select, you know, all these different kinds of things that I said go into it, and run it in probably a minute or two. So it's kind of like portfolio visualizer. You just put the parameters in and make the run, and it outputs charts and all this kind of stuff to look at. So yeah, I don't know, you know, I know Richard. I mean, he's from our computer, well, he's from our chapter. He's one of the board members of our Silicon Valley chapter. I can get with him and go over some of his questions in detail.
Well, another one that I think is a good one is from William. He says, I've always learned that market timing doesn't work, but your analytics seem to show differently. I guess I'm a little confused by that. And I just personally add, I'm like William, I'm not a big believer in market timing. So could you say a little bit more about why your market timers are successful?
Well, you know, all of us a lot of times have ideas about what works, and we, you know, but until we actually test it, and that's what I meant in the very beginning when I said you have to come up with rules that you want to consistently follow over like a 20-year period of time. And then you implement those and you apply it to the universe. And if it works over a 21-year period of time, you expect that it probably will work for the future. That's not always going to be the case, but that's what you expect. And so our timers don't all, you know, they sometimes don't work right in the sense that they might get you out. And when you get back in, you actually lose a little bit of money. But the main purpose of our timers is to avoid the huge, big, you know, drops of 40 or 50%. If you can save yourself from those, then you usually will come out ahead. I mean, when you look at those charts that I had, I could go back there and look at some of those charts maybe. So typically what's happening here is the timers, look, this got you out way back here and you were like flat for this whole period where this was dropping significantly. As you can see, you were out of the market for a lot of months here based on this simple moving monthly 8-month moving average of SPY. And so I'm not sure. I mean, this is showing that they're working for this particular index, and it works for SPY, so it's working. I'm not sure why you conclude that it doesn't work.
Maybe you could help by explaining the timer a little bit more in terms of what is it using to make the in and out of the market recommendation.
Okay, let me get back there to.
Yeah, that was my question too, is those timers to me look interesting, but surprisingly, some of the models that you showed don't even require the timers at all, that are best performers, that is. You know?
Yeah, well, let's see, I didn't, where was I didn't actually find that particular timer. I know I had it in there somewhere.
This is Gilbert. I just want to inject a thought where when you hear people say market timing don't work, that's if you leave market timing to human nature and emotion, you know, take you away. You will get out, but you will never get in or get in very, very late. What Don is showing is if you actually do a lot of research you can find out there is a method out of this madness, I think. Just like
Okay,
this.
this is that, yeah, that's,
Good
thank you,
point.
Gilbert. That's good. This is that simple moving average. It's an 8-month moving average. So the way this works is, so you take the simple moving average of the prices of SPY, and if the current price of SPY is, if the current price of SPY is greater than or equal to the 8-month average of the SPY prices, then you want to be in the equity or in the market. Otherwise, you switch over to T-bill. So if you were to go back in time and do this calculation using the SPY prices, this would tell you when to be in and out of the market. And if we go back to the chart, this, you know, every time we're up, the red is up here at the top, you're 100% in cash. And when you drop down to 0, then you're in the equity. So it was out for a long period of time. It got in for maybe a month. It might have been a bad decision, but the main thing you're trying to do with your timers is avoid, you know, something like this. You know, this one was an 80, you know, something like an 80% drop in QQQ, maybe only a 40 or 50 or 40% or something drop in SPY. But when you get here, it drops down to nearly, looks like nearly 60%, or yeah, nearly 60% you're down here in SPY in the financial crisis. And this got you out way back here just by using that simple algorithm. It got you out way back here and you were flat. You were just in T-bill for that whole period of time. And then, you know, you lost when it was coming back for a while, but then you got back in. So overall, you came out ahead compared to this is what happens when you don't do it. You take this big drop and then you're starting from a much lower point. You're trying to make it back up. And this, you get a 7.2% CAGR, and here you get an 8.7% CAGR.
So during that period that you're in cash there, Don, you are still withdrawing at the rate, you know, 4% or whatever it is, right? Is that the way I read that?
Yeah. Well, on this this particular chart was just the strategy without any withdrawals.
Yeah, I mean, I'm talking about your green ones, not necessarily this particular one.
Yeah. Yeah. So so the purpose for these charts was just to show how the strategy or the ticker did just by itself with no withdrawals, no taxes. So this gave you basically the returns that you would be getting each month for that whole 21-year period of time. So 21 times 12 monthly returns. So in this period, you'd only be getting T-bill returns, but in these other periods, you'd be getting the equity returns. And so then you take those returns and you use them, and then you start doing, you know, when I did the tax analysis, then I started doing withdrawals and I started paying taxes. And so then I was just continuing to withdraw funds. So these, you know, like I said, you know, if you use this curve and do that withdrawal technique and tax technique too, it starts running out of money. And particularly, this is the one with the Vanguard's dividend growth. This one totally runs out of money in like by 2019 when you
Yeah. Mm-hmm.
So you know, will timers continue to work like that in the future? If you end up with these big drawdowns, they're definitely going to get you out of the market. The question is, do they get you back into the market quick enough? And one of the reasons, you know, I invented this, well, let's go back here. I invented this timer several years ago. And part of the reason for having it be both a 5-month and a 1-month is by using and requiring that both be negative. When the market started recovering, the 1-month timer would go positive quicker and it would get you back into the market quicker. And then if both of them are negative, you get out of the market because, you know, the short term and longer term are both negative, so you get out of the market. But if either one of them go positive, and typically the one that goes positive is this 1 month after you've had a big drop, the 1 month will go positive before the 5-month will.
So these timers, how did you come up? How did you pick, 5 and 1? I don't understand. Was there something that mathematically it made sense to do that, or what?
Well, I mean, you basically try some different numbers that, you know, look reasonable. Whoops. Just based on your experience, you look for numbers that look reasonable and you test them out. You go 20 years and you test them, and if they're working, then they're, you know, over a long period of time with multiple down periods, then they should work for future down periods. That's the idea. Now, again, there's no guarantee of the future that they will work, but they've been working for at least 2 major drawdowns over the last 21 years.
Interesting.
You know,
More questions, Tom?
yeah, this is Homer. I've got a question.
Homer, did you have a question?
Yeah, I did. Can you hear me okay?
Yeah, sure.
First of all, Don, thank you for this. This is really very interesting. Really appreciate the information. You know, on the market timer, it would be useful to go through the exact calculations. Is that a 5-month and 1-month moving average? Is that what you're looking at?
No, well, actually, like this absolute, so this timer here, which is a composite of the 5 and the 1, this is the way you do it. You compute the 5-month gain of SPY.
Okay.
And you subtract the previous 5-month gain of T-bill.
Okay.
And so if that's negative,
I see.
so then that means that particular timer is negative.
Oh, I see. Okay.
And then you do it for this one. And if both of them are negative, then you get out of the market.
Oh, I see. Okay.
And if either one of them turn out to be positive, then you get
it. So one question is, are you checking this just once a month, or are you checking it daily, or how often do you check?
Just once a month at the end of the month.
At the end of the month. Okay.
Yeah, we ignore signals during the month, and you know, I've tested over time. I've tested various ideas where mid-month I could get out or get back in, and it always turns out in all of the tests that I've ever done, it always turns out that it is much better to just stick with it until the end of the month. Now, that might be another reason why some people say timers don't work, because a lot of people apply timers on a daily basis and a monthly. And so
do you do it on the first of every month?
Pardon?
You do it on the first of every month? You sit down and go through these calculations?
No, at the end of each month.
The last day of each month. Okay. The other question I have is, are you personally following the NASDAQ 100 strategy with the timers?
I am not currently. I have in the past. Several of us have followed the NASDAQ 100 strategy in the past, and maybe some are still doing it. I'm personally more, I'm more into some of the ones I didn't show that are leveraged, like there'd be 3x SPY.
Oh, I see.
Some combos with 3x SPY and so on. That's what I'm doing. I'm doing 3x SPY, maybe 3x MIDU, which is mid cap stocks, and sometimes I get into 3x small cap stocks. But these strategies right now seem to be doing better than the NASDAQ 100.
So,
but still using this specific market timer, ABS2M.
Well, some of them use the timer, some of them use that efficient frontier strategy.
Okay.
So the efficient frontier, the good thing about the efficient frontier strategy is that the covariance matrix that you compute for that, it turns out that the fundamental parameters that go into computing the covariance are correlation divided by standard deviation of a couple of things. So what you're basically doing is trying to look for negatively correlated stocks, which is something you always want to do, because if you've ever looked at a variance equation, when you start having a negative covariance, you actually reduce the variance by combining two assets which have a negative correlation. I don't know if you've ever gone through that process of calculating the variance of two assets when they have a negative correlation, but the covariance, it turns out, will help you reduce the standard deviation of the overall portfolio through that calculation. So that's why the efficient frontier is another nice way. It kind of automatically controls volatility, because you're shooting for a target, on this, wherever it was. So on this, you can put any set of assets into this efficient frontier, and you can pick a portfolio standard deviation target. So it keeps telling you which of all the assets you're considering are the ones to invest in at that particular portfolio standard deviation. So it kind of controls your volatility, because it keeps shooting for that at the end of each month. And in the past, I've put out a chart like this every month to see what happens. And it kind of jumps around a little bit because covariance changes. You go one more month and you're still using the past 105 days for the covariance matrix, daily returns to go into the covariance matrix. So it jumps around a little bit, but it's very interesting. And I actually output all of the allocations every month. When I make these runs, starting back in 1999, I show all of the allocations monthly for all of this. But all of our strategies right now are working on a month-end basis. And we don't make any changes during the month. And that's good in the sense that it keeps us from having to spend a lot of time. I mean, I'll say, maybe others can spend an hour or two a month. I spend a lot more than an hour or two a month generating all this and trying to come up with ideas for new stuff. But for others who, after they've done their due diligence and they say, okay, I decided I wanted to follow this particular strategy, going to the allocation table and just making a decision, just following it, it makes it very easy. So you just, if you wanted to do the dividend aristocrats, for example, at the end of last month, you would have invested in these 10 stocks equally weighted. And so you just do that. And each month, I do, someone asked the question, I think, how many trades per year? I collect that data. I could give that for any one of these strategies, but for something like the timing strategy where you're staying in SPY, say, well, let's see, where are they? Where you're staying, this time strategy with SPY and StormGuard Armor. Each month, if the timer says be in SPY, you do nothing. You don't have to make any change. So you go lots of months while the timer is not fired and you're just sitting there in SPY. And then when it fires, you go to cash or T-bills or something, money market, whatever. And then you just sit there in money market until it turns around the other way. So very little trades in that strategy for sure. This dividend aristocrat strategy would probably have a fair amount of trades because you also rebalance. That's the other thing that happens is you rebalance every month. So if it says invest in these top 10, you want to rebalance to get to the 10% in each of the tickers each month. This strategy, the percentages in each of the stocks that it picks would probably vary a little bit. You'd have to rebalance there, but you're not selling the whole thing and buying a whole new thing. You're selling a little bit and maybe buying a little bit, that kind of thing. A strategy like Peter's simple strategy here, you would typically probably stick in the same stocks for a while, but you would have to do the rebalancing. So like I said, it should take you less than 2 hours a month if you wanted to follow one of these strategies. And you know, originally when we started off, we asked Andy for benchmarks. I only found these as possible benchmarks that had enough history. You know, some of the I forgot who has it, but there is a pretty high performing thing that I've seen from your group, SCA, or I mean, it's a Schwab kind of dividend.
CHD, yeah.
What is it?
It's Schwab. It's a Schwab dividend, SCHD.
Yeah, SCHD, yeah. So I saw that, but since it had short history and the history was only during a high performance time, I couldn't really use it. And some of the ETFs also had very short history. So I needed something that would go back. If any of you had better benchmarks that we could use, I would be able to put those in and make these comparisons as well. But for now, these were the best I could come up with, and they're not perfect by any means, but they're at least one kind of benchmark that we were able to use. So like I say, if any of you have suggestions for other benchmarks, I'd appreciate it, and we can do an update to this thing. The other thing that we could do is if some of you had, say, a portfolio of stocks you'd like to see run for a 21-year period of time, if they had 21 years of history, and you wanted to start off with a fixed portfolio and, you know, either rebalance them monthly or just let them run, I could do a run on something like that too.
We tried to, I tried suggesting to Peter and to Don to use the AAII dividend newsletter, which I thought would be a good way to go about this, but as it turned out, it was not so good. You know, it turned out to be kind of a ho-hum performance criteria when you compare it to some of these benchmarks and some of these tactical approaches.
Yeah. Well, you know, the only one I threw in here that was a little bit aggressive was this NASDAQ 100, which, you know, it's not even the best performer over the past 21 years. I mean, this one was around 30%. Some of the ones we have in our list get up to 46% compounded per year, but they use some leveraged funds to do that, but still with super high performance. I didn't think they were appropriate for a dividend investing group, which tends to be a little bit more conservative. But all the rest of these are pretty, I would say, relatively conservative and definitely worth consideration for your group as an alternative, as a simple alternative. And like I say, this was dedicated mostly to people who don't want to spend the extra time to do all the individual stock analysis. If you enjoy that and you like to do it like Andy, then, you know, this isn't for you. But for those of you who would rather play golf or do something, maybe some of this might be helpful to you. And I see
did we get all the questions answered here?
I do see a question here. It appears that there are going to be lots of taxable events, both short and long term. So I'm a little mixed up, but do the returns reflect after-tax returns? Definitely. All of this work back here. So these were all the analysis in a taxable account. Well, in all of them, I do taxes. So let me show you a detail here. So you start at $1 million, and you know, so you don't have any taxes, and you're starting at the end of 1999 at December 31st. So these are the taxes that you're paying, and they are coming out. They are coming. All of these taxes are coming out of the of these returns. These are the final values after you've pulled out living expenses, you know, 40,000 up to 74,000 each year. And also after you've paid all of the taxes each year. So these are the final values after withdrawals and after taxes. So everything is net of everything, taxes and living, you know, I call these withdrawals or living expenses, whatever you want to call them. But these have been pulled out of the portfolio. This is a withdrawal per year. And these are the total taxes per year. And both of those have been taken out of this portfolio. And in some cases, like with this high performer, because this thing grows so much, you're paying a ton of taxes out here. I mean, you're paying like here, 33,600,000 that year, 2020. That's what I'm saying about, you know, some of these years, recent years have been super high performing years. So you're ending up paying a lot of taxes. You know, you're withdrawing this much, but you're paying all these taxes. And you're still ending up with $16 million at the end of 21 years if you use that strategy. If you could go the next 21 years and get this kind of result out of your strategies, this is where you would end up.
I've got a question to ask if I could.
Sure.
Yeah. Do you think the primary factors that are generating the outstanding performance in your top performing models that you're testing here, is it primarily due to the asset allocation mix, or is it due to avoiding the drawdowns, or what in your estimation, if you sum this up, you know, in key points that results in this outstanding performance?
Well, it's probably mostly, let's see here, let me go back here. Okay. So this is that high performer, and this is red is its curve. You know, you see there are periods of time, you know, I was in it and then it started, so I might get out in here, and then it's been going like gangbusters here, and then it comes back out. Most of this performance is due to the fact that, you know, QQQ or NASDAQ 100 stocks have done, you know, after their big drops here, have done really well. I mean, they were way down here and they caught up and passed the S&P 500 over, you know, since, you know, the financial crisis was over. It's had much higher gains. It avoided this big drop in the NASDAQ with these timers. You know, they were firing off and on. They weren't getting it right all the time, but they were attempting to avoid this big drop down here in the NASDAQ 100 type stocks. But so because it was getting you out of the market a lot over here, you didn't experience this kind of a drop. And then you're doing the typical momentum play. You're picking the top 6 performers, and some of these top performers, particularly in here, you're having Tesla just, you know, knock it out of the park. And so you're getting all the gains. I mean, in this period of time, you're having Zoom, Tesla, Moderna, were all in the NASDAQ top 6 in this period of time, about the time we started having the virus problem. And so that's, I would say that it's a combination of the universe and the momentum of that universe, and the consistency of those top ones is mostly the reason for the gain, but you cannot at all discount how well the timers did in terms of keeping you out of these big downdrafts here in the market, in the NASDAQ market. So that's, I don't know if that answered your question, but that's kind of what my long-winded bottom line would be.
No, I appreciate that. But I'm not sure I understood the response you gave to Andy's question earlier, which is you really had some excellent performance in some of these models that didn't even incorporate the market timing. So that must have been fund or benchmark selection.
No, well, let me show you one here. Okay, this one is this uses that efficient frontier equation where you got the covariance matrix and you have the returns. And so each month it is doing that calculation on these 3 assets, and it's picking the mix of those assets which get the highest return at this portfolio standard deviation target. So there's no timer in here at all. And look at this curve. I mean, it went right through these drawdowns with no problem at all. And there's no timer in here. There's no timer back here. What it was doing back here was getting into T-bill. I mean, not the T-bills, but into TLT. If you were to look at the allocations back in here, it would probably be having a high percentage in TLT and not much in SPY or QQQ, just based on the way that algorithm works. And the same thing here. The reason this popped up so much, this goal line is a relative strength. The reason that popped up so much compared to this big drop is it was going into TLT, which is long-term bonds in this period of time. But you cannot complain about the shape of that curve. I mean, it is nearly straight up.
So it's not so much a timer as it is switching the allocations,
Right.
which is kind of it's sort of a timing thing, but it's the timing between the allocations. Is that right?
Yeah, it is not, the typical timer. I mean, we have what we call binary timers. Binary timers get you totally into the market or totally out of the market. It makes one decision and you're either in or out. We have some other timers, we call them, Peter came up with a lot of these, they were called composite timers. And the composite timers might be 3 timers put together. So if 2 out of the 3 timers were positive, 1 was negative, it would maybe be 2/3 in equities and 1/3 in cash. So those are what we call fractional timers because they're not binary. You're either in or out. They're just some percentage in or whatever. So, but those are calculated and they make an overall decision about being in equities or not in equities. This strategy here with the efficient frontier, it would do that Markowitz optimization problem. It'd solve it with the covariance matrix, and it would come up with this mix of stocks is the right mix to be in. I could send Andy a table that would show the monthly allocation of these assets over time, starting from December of 1999. So if you were interested, you could look at how it made its decision over time to get into one or more and in what percentages for these strategies.
So it would change the allocations over time.
Yes, it would change the allocation. So like in here, it was maybe either 100% in TLT and 0 in SPY or QQQ, or at a minimum, it'd be like 80 or 90% in TLT. And the same back in here is probably what it would be. And then as it started getting out there, where things got more stable, it would start getting into maybe QQQ, because QQQ was having a good growth rate here. And maybe SPY wasn't doing as well, so it would maybe start getting more into QQQ and SPY rather than TLT. But it was a gradual adjustment of the portfolio investments over time.
Right. That's great. Have you looked at long short strategies?
I have a little bit in the past, but not, we don't have any current strategies that try to do short.
Okay.
Don, this is Rick Jessel. I really appreciate your presentation. This is a tremendous amount of work. Is the best email to see the allocations donwmcomcast.net?
Yeah, I always leave the @ sign off, but yeah, at comcast.net.
Okay.
So let's go back here.
Well, this is very generous and extremely impressive.
Yeah, just put the @ sign in there. I just leave it off in case sometimes people scan this stuff, although that wouldn't be hard to figure out. But yeah, Don WM at comcast.net. If any of you want to send me a question or whatever, please do, and I'll give you an answer and supply some data if I have it.
Yeah, and a shameless plug for the Silicon Valley SIG, because these guys are doing some tremendous work here, and so and they're doing it on an ongoing basis. So, I think that it would be worthwhile, for those that are interested to, to join their group. I mean, it's just down the road, so to speak, and widely available. And they have a Google group, and
Yep.
they have their
Well,
meetings as well.
Yeah, I'm showing it. So again, like I said early in the presentation, just join our Google group, and you'll at least get email notices about the meetings. You can also go to this link for meetup.com and look for the computerized investing meeting and sign up there, and then you'll be notified every time we have a meeting. But it's easy because the first Thursday of each month, and so far every month we haven't had any breaks at this Zoom. You can find it, and if this isn't a convenient time for you, you can go to our OneDrive, and we have recordings of all of our meetings, and you can go down to the Zoom meeting folder, and you can find every one of our meetings. I mean, there are a few cases where I forgot to turn on the record, and so we miss those, but I think all but one, or maybe, yeah, I think all but one, I think we got. So if this isn't a convenient time for you, you can always wait for a few days, and then the meeting will be uploaded to the OneDrive, and you can go listen to the recording. And also, all the presentations and all of the runs that I do, I upload all that data into the OneDrive, so you can go look at that and review there. And again, I get questions from a lot of people, and I try my best to give them answers. And so please send me anything you got.
Did we finish all the questions in the chat list here? I hope we have, because we're coming up on 4 o'clock here. So,
okay, I see that Pat had a question. Will this Zoom be on the Silicon Valley OneDrive? You're going to have it on your link, right?
yes, we'll put it on our link, and then if you'd like, we can certainly give the link to everybody in the Silicon Valley chapter. Yeah.
Yeah, if you could, Andy, if you could send to our Google group the link to this meeting.
I will do that, yeah.
Or to the recording, that would be great. And then, yeah, we won't have it on our OneDrive, but it will be on Andy's.
Okay.
Site.
All right. Any other questions for Don?
Yeah, I kind of, I don't know if I could read all these things, but I'm just kind of scanning here, Andy, to see if
I'm sure once I've had a chance to look at your presentation again, I'll have some more questions. I may
okay,
ask
well,
you some questions.
like I said to everybody, if you have additional questions, you can get me at this web or email, and I'll give the best answer I can.
Yeah, sure. All right.
And-
So,
And thanks for inviting me, Andy.
Yeah.
And I hope I was able to give a different perspective than some of the presentations at your group.
well, we have, as I said earlier, we have a lot of fundamental analysis folks, but we also have people who want to use ETFs and funds to do investing, and they don't want to spend a lot of time. They'd rather be out playing golf, and that's okay. And so I think this approach seems to make a lot more sense for those folks, and I'm sure that you'll get a lot of questions from it too. Any more questions for Don before we kind of wrap up here? Okay, then would you release your screen there, and I'll get back to my slides there, Don.
Sure. There you go.
Todd, are you still online by any chance?
Yes, I am, Andy.
Do you want to talk a little bit about what's coming up in the fall?
We're working on some things. We don't have the specifics yet, but we're working on additional meetings for the fall. So we'll provide that information as soon as we have it.
Okay. All right. So just to wrap things up here, get to the back to that. Oops. Well, I want to thank Don. Thanks very much, Don, for taking the time. I know this was a lot of work for you, and but I think that some of the things that the Silicon Valley Computerized Investing Group is doing, and by the way, all these SIGs in Silicon Valley and in other chapters are well worth your time. I think you guys should encourage everybody to explore them, because there's some very good ideas out there, some very good information, and it's free. It's part of your membership at AAII. So I'm always looking for prospective speakers. Just wanted to mention that again. Peter will be here for the July meeting, and he will give you a little different perspective from the approach that Don has gotten presented here. But again, one that I find is very interesting, and you might find very valuable too from an income investor point of view. And don't forget our Google group. We're here to chat with each other. It's a friendly group. And you can exchange ideas there all the time. And by all means, don't hesitate to get involved with the Silicon Valley chapters as well. So I'm going to wrap it up here unless I have any other comments from anybody else. And we'll call it for quits here and go from there. And our next meeting will be July the 11th. And the photo here is, by the way, there's a lot of talk about inflation. This is a picture of the Weimar Republic, and this is what happened when inflation got out of hand. As you can see, she's paying for something with a bucket of money here, or with a load of money. So we'll see everybody on July the 11th, and have a nice day. Bye-bye.
Thanks, Andy.
Thank you.
Thanks, Andy.
Thanks, Don. Thanks, Andy.